And welcome to the ETF Edge portion of Halftime Report. I'm Bob Pisani. The battle between growth and value continues, as does the battle between weighting by fundamentals or by market capitalization. WisdomTree has just launched its Growth and Momentum ETF, symbol WGRO, that seeks to capture the upside of aggressive growth with lower drawdowns and volatility. Neat trick here. Let's talk to the man in charge and see if they can pull this off. Jeremy Schwartz is the global head of research at WisdomTree. Andrew McCorman from Wallach Capital joins us as well. Jeremy, this is an interesting attempt to capture two fundamental components that investors have become very intrigued with in the last decade: aggressive earnings growth combined with momentum. Now, how do you decide what goes into this index?
We have really unique partners on this index as well. Some of the earliest growth investors, Bill O'Neill, the founder of Investors Business Daily, has the CAN-SLIM methodology for identifying growth stocks, has created this unique methodology saying when you go to growth stocks, most of the indexes have no regard for tactical entry points, tactical exits. How do you not find stocks that are overly crowded? And so this is hopefully going to give you some of those prime O'Neill-style growth stocks with those downward volatility adjustments to avoid overcrowding, finding the right entry points and exits. And when you think about where momentum has been, most momentum funds, the academics say you should rebalance monthly. The most popular momentum ETF only trades twice a year. So it really solves both of those factors, growth and momentum.
Yeah, that's MTUM you're referring to. Now, Andrew, this issue has been debated for decades. Why have an index market cap weighted when it makes more sense to weight it by, say, fundamentals, by, for example, earnings growth or dividends or momentum or even sales? Is there any evidence that weighting by fundamentals works better than weighting by market cap? And if so, what fundamentals? Tell us.
Here's the thing. I won't argue the fact that if an S&P 500 with a 30-year time horizon is going to, and a low cost, is going to outperform everything. But what's the reality? Not everybody has a 30-year time horizon. So let's just focus on one factor, momentum. The thing you have to understand about momentum, it looks a lot like growth stocks, because that's where the momentum is right now, but momentum has no bias, right, at all, and does not discriminate. So what does that mean? Well, those names can go up regardless of any fundamentals or technicals, or just the momentum of that stock. I guess technical could be the money going into it. But this is what I like about this WisdomTree ETF. It's equal weighted. So don't think of it as the upside, which of course is there. Think of equal weighting protecting you on the downside. When a momentum name is high for no reason other than just Robinhood piling into the name, that is likely going to correct at some point, and the equal weighting monthly will try to dampen that and actually return some alpha in the return of no downside.